Maybe let's just start there and your take on Alphabet and some of the concerns in the market today around those earnings.
Well, we really don't look at things quarter to quarter, week to week, year to year. We think Alphabet's a great company. It continues to produce cash flow, and this is what makes the company valuable. It continues to modify its business plan. It does the things necessary to build shareholder value. And as such, we think it is itself a good value. It's taken its very strong position in search, and it's expanded that. It's become a dominant place to place advertising, et cetera, et cetera. So whether it's this quarter or next quarter, we think Alphabet is doing what it takes to build shareholder value, and that's what makes us happy shareholders of the company.
What about valuations overall? I mean, December, really all of last autumn was pretty brutal. I think your fund got swept up in it. Talk about December performance and what sort of opportunities that gave you for the beginning of the new year.
Yeah, if you look at our global and international funds, we have been hit quite hard as a result of our exposure into certain areas that really faced downward pricing pressure, specifically European financials and even some of the industrials in Europe. And in fact, today, I believe that this is where we find some of the best value in the world today. Many of these stocks are down 30 to 40% year over year, and if anything, have increased earnings. And some of the financials like a Credit Suisse, or even a BNP Paribas in France, or a Lloyds Bank, or industrials like a Daimler or a CNH. These are companies that have lost over 30% of their value in US dollar terms, which have maintained, and if not, will grow earnings in the next couple of years. So we think these are very attractive. And despite the fact that we've kind of been beat up by them last year, we think they offer excellent value and will propel future returns over the next couple of years.
David, in the global fund where you have the opportunity to go anywhere in the world, where are you finding more ideas right now? It seems as if, at least at last report, the U.S. exposure was about 45%, which seems a little bit, maybe even a slight underweight versus the benchmark. So where do you find there to be better values?
We are a little underweight the U.S., and it's not for lack of value in the U.S. We are able to find value there. It's just other sectors of the world have really been clobbered, actually worse than the U.S. last year. And if, again, you go to Europe, it's been marred by all the political situation, the Brexit, the fighting with the Italians, so on and so forth, slow growth. It has meant extremely weak share prices. And again, even though share prices have been weak, we still see acceptable rates of growth because European companies, of course, sell and generate cash flow all over the world, not just in Europe. So we think Europe is really one of the places in the world where there is acute value. There's very extreme value in Europe. Europe should trade, a European company should trade at a discount to a U.S. company because the return structure of European companies tends to be a little bit less than the U.S. But the discount today is probably bigger than it should be. And then if you look at Japan, another place where investors go, it should even trade at a bigger discount. And it probably doesn't trade at enough of a discount. So as by process of elimination, we're actually finding some of the better values today around the globe in continental Europe, including the UK,